So I start with the homework. I propose two kinds of homework. First homework, I put it few seconds ago on Canvas. Here you can see example homework. In this kind of homework, so I share the screen. Sorry, it's not this one. Oh, here. Where I share the screen. Yes, here. Okay. So in Canvas, the last module I put is homework example, few seconds ago, discounted value creation and NPV case. So in this kind of homework, you have to do by group of two. So we'll determine the group of two with the secretary. You have to complete this kind of Excel file. You have data about operating activity. You have data about investments. You have data about changes. We expect to increase the volume, to modify the selling price, to have new investments, to spend more in the cash fixed cost. In function of all the inputs, you have to complete the two models, one with the calculation of the market value added for the project from the economic profit, and the other one with the NPV, and to check you finish with the same solution. In this kind of homework, I will put questions about the use of sensitivity analysis. So you will have to do some sensitivity analysis, to use the solver, to use the goal-seek, sensitivity analysis, goal-seek, solver. We can also have the forecast sheet, maybe, or the scenario managers. So I will create questions in order to use some functionalities of Excel, okay? So this is one kind of homework, very technical, and with the usage of Excel in order to see the impact of different evolution. What if we have no 300,000 but 400,000 at the beginning? What if the cash variable cost represent 50% and not 60%? Or we expect NPV of 1 million by changing the sales volume. What is the needed sales volume in order to reach target NPV of 1 million, for instance? So many things about the use of Excel and the creation of financial model. This is the first kind of homework you can take by a group of two people. The other homework, it's about the statement of cash flows. So you have to decide which American company you want to study. Why I want an American company? With the American company, we can find very easily the Excel files. So for instance, I want Starbucks 10K 2020, the Excel file. It's compulsory to give the Excel file because of the SEC demand. So it's what they name the SEC fillings. They have to give the 10K every year in 4 formats. They need to give the PDF, the HTML, the XLS, Excel, and the Word document. So you can have the Excel file, okay? Here, you can have the Excel file. So I already have this one for Starbucks. So here is Starbucks. So you will open this kind of Excel, like here, and you will find the balance sheet. Where is the balance sheet? The income statement, the balance sheet. and the statement of cash flows, cash flow statement, okay? In this exercise, what you have to do is to try to explain the difference between the change in value we have here from the balance sheet and the change is a cash effect. So I take the amount at the end of September 2020 minus the amount at the end of September 2019. So it's not relevant, this one, because of course we have all the cash effect. If we change cash, it's because of the cash effect. So here is the same. So it's not relevant for the first line item, but for all the rest, you will have changes. You compare the change you have from the balance sheet with the information available in your cash flow statement. So you can explain different element of changes here because of the investing activities and so on. And you try to explain why you have a difference between the two. So change without a cash effect by difference. And here, for each time, you try to explain. Explanation of the difference. So it's interesting when you study the cash, the capacity of a company to create a cash, to compare what is available in terms of analysis of the cash flows, thanks to the statement of cash flows, and what could be the change in cash if all the changes in the balance sheet is with a cash effect. So for instance, maybe in the change in the debt, or we will go to the long-term debt, is current portion, short-term, long-term. We don't have long-term debt. Here, the change in long-term debt is $3,492.6 million of dollars. So in billions, 3.5 billion. This change may be at the level of the cash flows. It's only 2 million. Why I have the difference between the two? I have a difference between the two, maybe because I convert some debt is converted into shares. So it's without a cash effect. So generally, when we see the evolution of the balance sheet, we want to understand what is with a cash effect, what is without the cash effect. And we can try to find the explanation in the rest of the tables or inside the annual report. So in this case, this situation, if you analyze the situation of a company and you try to understand why what you see in your statement of cash flows is not what you could have from the balance sheet, you try to have some element of financial analysis to understand the differences. So it's more interpretations, more to try to analyze the accounting documents, the notes, in order to understand why we can have differences between the two. Okay, so two kinds of homeworks. One very technical about Excel and the creation of financial models. We will create charts and so on. I will ask a question about this, and I will give you the final homework you have to do on Monday. I will do it during the weekend. I will create the questions and I will modify the case study. I have also to create one different Excel file per group to be sure you did the work by group. So I need first you decide which kind of case study you prefer. One about the real company, and we want to analyze the differences in the balance sheet with a cash effect and without a cash effect. Or the other case study, it's about the technical aspect of Excel. And in this case, I have to create one different Excel file per group. So maybe you can decide until Tuesday, and you can send me the what you want to do. But we need first the groups. So I have to ask to Tram and Lynn to create the groups, and after you decide by group. So maybe they will create the group on Monday, and you decide on Tuesday and Wednesday what you want to do. In function of what you want to do, which company you want to study, if you take this kind of homework, or if you prefer to compare the NPV with the market value added. In function of your decisions, I have to decide how many MPV and MVA Excel file I have to create. Okay, because I prefer you have a different version each group in order to be sure you are working in your group. And if you take a company, you have to take a different company per group. Okay. Is it clear what you have to do? Group of 2 or 3. Finally, we will take a group of 2. Okay. It's better for the coordination. If you want to work, it's better if you work with only one other people than by group of 3. It's too complicated. You have your professional life, your family life, plus the homework. So by group of 2, I think it's better for you. By group of 3 is too complex for the coordination. Okay. So finally, by group of 2 people. So I put on Canvas one example of the financial model, but without the questions. So I will ask you questions about and for which you have to answer with the use of the goal-seek, data table, the solver, and you have to create charts. Okay, in order to use Excel and to be able to use some functionalities of Excel. Very useful for a forecasting process and okay. And if you decide to take a real company, take American company, because in this case we can have easily the Excel file, so you can directly work on the Excel file and try to explain differences we have here. So we can have differences also because of the acquisition of the company. So if we have acquisition, we pay for that, so we have a cash effect. So for the acquisition of company, you have to put with the cash effect. And without the cash effect, you can explain because of the non-cash expense, non-cash revenue, because of decision to convert debt into equity. So you have to try to separate the two here and to explain the difference. And after you can create an overall comment about what we see in terms of cash and the differences because of accruals and other things. Okay, so you have until we can say until Wednesday of the next week to decide, and I need to send an email to Tram and Lynn to check if the groups are already done and to give you the groups. And for the moment, you don't have a groups, no? You don't have a list of the group. Do you have a list with the group already or not? We already shaped group of 3 each. Okay. Okay, you have already group of 3. In this case, it's not a problem. If you prefer group of 3, it's possible. If you already did this work, we can keep the group of 3. No problem. Okay. So all the 45 are in the group of 3. So you have 15 group of 3. We'll send you the list of students for group. Okay. So you can take the group of 3, no problem. So we do with the group of 3. It's just for the coordination. I hope it's not a problem for you. We keep the group of 3, and you decide what you prefer. You say, I prefer the MPV project, or I prefer the comparison between balance sheet and statement of cash flows. Okay. And you give me the list with your choice, if you can, by Monday. And after, I will send you the questions, the wording of what you have to do exactly. Okay. So you decide if you prefer the NPV project with a lot of use of Excel, or if you prefer the statement of cash flows and the comparison with the change in balance sheet. Okay, so today we continue with the slides, and today we will see how to manage the working capital. And I forgot, you asked it for example of working capital, and net cash. I put it's a chapter 15 in this book, the same. In the chapter 15, they explain the simplified balance sheet, okay? So I scanned the chapter 15 about the simplified balance sheet. So you have one example of different companies, and we see what is the meaning of this kind of working capital by comparison with the working capital requirement and the net cash. So you have this. At the end, if we have time, I will present you the previous final exam, but the idea is MCQ. And if it's possible, what I prefer is to do the MCQ and you put the equation, how did you calculate it, beside your calculation, if we can do it on the paper format. If it's on Canvas, maybe it's not possible to put your equation. So it depends in which format you will have the final exam. Final exam on the paper format, you write your equation. It's a way to have points with a bad result. If it's on Canvas, I will put simplify the questions, but you don't have the possibility to show your calculation. So we continue. So yesterday it was about the free cash flow. So we finished today with the free cash flow, and after we will see how to manage the working capital. So for the free cash flow is related to what we name the Boston Consulting Group matrix. The Boston Consulting Group matrix created a tool in order to manage a portfolio of activities in the companies. And what we want is to manage the free cash flow, the capacity to create more operating cash flows than what we need because of the investing activities in property, plant and equipment, and intangible assets. So in this presentation, we have 4 cells, and we have the market growth rate and the relative market share. So we have to define the threshold. Here they decided to put the threshold at 10%. More than 10%, you are above, and below 10%, you have below in these cells. So, and the relative market share, what is the relative market share? If we suppose the threshold it's at 1.5 or 1.6, 1.6. You take the market share for your activity on your market. So for instance, you have a market share of 20%. And you are the leader. You have the highest market share on this market. The next one has 15%. After you have 40% and so on. And at the end, you have the 100%. The relative market share means you compare your market share with the main competitor on the market. So the next one. So here we have 20% divided by 15%. This is how do you calculate the relative market share. So of course, if you are not the leader, you have another one at 30%. In this case, your relative market share is below 1 because you compare the 20% with the 30%. So here, more than 1, you are the leader in this part. But in this presentation, we consider is not enough. We must have a much higher market share than the next competitor on the market. And the bubbles is in function of the size of the sales revenue. Okay. So here, high sales revenue, and here very low sales revenue. In this way, we will classify the different activities with the sales revenue for each business activities. We put a names for the 4 categories. 1, 2, 3, and 4. And this approach is related to the life cycle. At the beginning of the life of a product, we are supposed to be a star or a problem child. It depends if you have the first company on the market, you created the market. In this case, you are a star. If you enter in the market after the other competitors, first, you are a problem child. So it's because of the market share, okay? And the idea of this matrix is to check the capacity to transform a star into a cash cow or to transform a problem child into a cash cow. So at the beginning, you will spend a lot of cash because of the market growth. Because of the market growth, we determine the net capex. If the growth rate on the market is 20%, 50%, 100%, you need to invest a lot in order to sell in function of the demand. So because of the market growth axis, you can determine the net capex. And with the market share axis, you are supposed to determine the operating cash flow. If you have a huge market share, you are supposed to have a huge operating cash flow. You have the capacity to negotiate with the suppliers and the customers good credit terms. You have a huge sales revenue, so you have the capacity, the potential capacity to create a huge operating cash flow. So it's related to the size. We suppose we have economies of scales, learning effects, and so on in this approach. So in terms of free cash flow, the worst situation is the number 2. The free cash flow is highly negative because the net capex is very high and the operating cash flow can be very negative. We have a low market share, but so we don't have the capacity to create a huge operating cash flow. And at the same time, we need to invest a lot in order to sell the products in function of the demand. And the best situation in terms of free cash flow is the situation number 3. Now the market growth is low, so the net capex is low. And we have a huge market share, so the operating cash flow is high. Here, normally, we create a cash cow at the moment of the maturity stage. So it's related to the life cycle. We have the evolution of the market. So at the beginning, the question is, do we have a new market? So you try, do we have a new market? So we try to create a market because we identify some needs from the customers not already satisfied by other products. So we invent a new product and we try to sell it to a huge proportion of the customers. Maybe we will create a market, maybe it's not a market. We will know if we have a market after the stage of the introduction, at the stage of the acceleration. If we have an acceleration of the demand, now we can suppose we have a market. So now we can have a huge increase from 200%, 300%, 400%, but maybe it's not very huge in volume, is because you start from nothing. So the volume are very low, so now the increase can be very high in percentage. And the question is, can you continue your activity at the maturity stage? At the maturity stage, we don't have a growth. So the growth rate now is 0 here, 0%. Here we have a change. We decrease after this one. We have a decrease in growth rate. And before this point, we have an increase in growth rate. So because of the decrease in growth rate and the perspective to have 0 in terms of the market growth rate, some company will create forecast, and in the forecast, they understand it's not possible to continue with this activity because we expect losses, we expect a negative return, we expect negative free cash flow in the future. We are supposed to continue at the maturity level only because you have a huge market share. So thanks to the market share, you have the capacity to enter to a new stage, the stage of the productivity. Productivity, efficiency. So in the first part, the question is not the question of the reduction of the cost. In the introduction and acceleration, what you want is to have the good product for the customers. In these different stages, introduction, acceleration, you need to spend a lot in marketing in order to be sure your product is known by the customers. So in the introduction and acceleration, you spend a lot of cash because of the marketing expenses, because of the investments in property, plant, equipment, and intangible assets. So in the first part, introduction and acceleration, you can have losses in your P&L. It depends on your investments. It depends on the spending in marketing. But the question is not the question of the efficiency or productivity, because we have an accelerated stage. So at this part, the question is, do you have the capacity to increase what you offer to the customers in order to increase your market share? Now, after the perspective, now it's a small growth rate for the market. You don't want to continue with the market share. It's too expensive. So when you increase your market share, normally you spend a lot in marketing. So when you are at this stage, the marketing expenses are very high. And generally, it's cash expense. So you have to pay for that. So because of this, you are reducing the operating cash flow. But if the growth rate is very low, you don't want to continue to increase your market share or to defend your market share. It's not relevant because it's too expensive. Now, at this stage, at the maturity stage, is finished with the market share. It's not the KPI in your decisions. So here I define some key performance indicators. Because you don't care anymore about the market share, now you can reduce the marketing expenses. You can increase the free cash flow. And with your free cash flow, with positive free cash flow, Now you can finance new stars, you can finance new problem child. So thanks to the old activity and the positive free cash flow, you can finance the new activities with negative free cash flows. And for all the companies, at the end, you manage the free cash flow for all the company. And you are supposed to increase the free cash flow year after year if you are a big company. So in function of the stage in the life cycle, you don't have the same target for your key performance indicators. If you are at the introduction stage, you don't care about the competitors. You are alone on the market or you are few competitors. So here you are focused on your performance, your commercial performance. So you are creating a lot of indicators in order to anticipate, to forecast the evolution of the sales revenue. So the key performance indicators are about the capacity to create a sales revenue. In the second step of the life cycle, now because you have huge growth rate, you have new competitors which are coming on your market. Now the problem is not just the capacity to increase your sales revenue. The problem is the capacity to increase your sales revenue more than the other competitors. So it means you try to increase your market share. In order to stay on this industry, to stay in this business activity, in the stage number 3, at the maturity level. So at the maturity level, not all the companies are supposed to stay here. So at the end of the stage number 2, many companies will be sold to other companies because there are not enough, they don't create enough P&L, enough net profit, enough sales revenue to stay in this industry in the stage number 3. So they can have a lot of negative free cash flow in the stage number 3 if the market share is very low. So now we are supposed to transform negative free cash flow into positive free cash flow at the stage number 3, but we suppose is related to your market share. It's easier if you have a huge market share to create a positive free cash flow than if you have a small market share. At the stage number 3, now you expect to create huge free cash flow because you reduce the commercial expenses, the marketing expenses, because of the efficiency, productivity, the capacity to reduce the unit cost and to reduce, in particular, the cash expense. You are supposed also to have positive return on capital employed, and to increase the return on capital employed because you have efficiency in the way you manage your working capital requirement, because of the productivity of your investments in property, plant, equipment, and intangible assets, and because of the capacity to reduce the unit cost by comparison with the selling price. At the end, your target is only free cash flow because you are supposed to stop the activity. So you want the maximum of free cash flow in order to finance the new activities. So you are supposed to have different curves at the same time because you have different business activities and you want to continue to live in these industries, in the different industries. So you are supposed to replace one product by another one. So you are supposed to manage different products with different technologies, with different demands at the same time. So in function of the market share, we are supposed to have an indication about the operating cash flow. In function of the market growth, we are supposed to have an indication about the capital expenditure or net capital expenditure. If you go to the left, you increase the operating cash flow. On the right, you decrease the operating cash flow. If you have a huge market growth, you have a huge capital expenditure. huge, positive huge, okay? But it means a cash outflow. And you have a low net capex if you are supposed to have a small market growth. So the best situation in terms of free cash flow, huge operating cash flow, very small net capex. So this is why we name it cash cow, the capacity to create a huge cash flow. So we have some definitions about the different stages and the strategic aspects and the financial aspects. So at the beginning, you are supposed to have a low revenue, to be unprofitable, and you need to have the funds in order to finance your negative P&L, to finance what you need because of the working capital requirement and the investments in non-current assets. At the growth stage, you are supposed to increase your market share. You continue to define your product and your strategy. It's not totally defined. You need to increase your manufacturing capacities and the commercial capacities. The problem is not the efficiency. So you want an exponential growth in revenue. Maybe you are still unprofitable because you have huge investments. So you need, from the financing activity, the capacity to finance for the operating cash flow and the investing cash flow. At the maturity level, is totally different now. All is totally defined. So it's finished with the strategy. You know what is the product and you don't modify the product. So now you have stable revenues and stable market share. Because it's just a question of replacement. The customer purchased your products in the past and now they replace the product by the new one, but it's quite the same one. So you are supposed to keep the same market share. You are not supposed to decrease your market share because the customers know very well your product. So it's easy to keep your market share without spending in commercial expense. Now you are supposed to reach the profitability and to create enough cash flow in order to finance your net capex, to repay the debt, and to give some dividends. The problem now is the efficiency, the capacity to reduce the cost. So normally at the stage of the introduction and the growth, you don't distribute dividends and you don't repay too much debt. You have more new debt than repayment of debt. At the stage of the maturity, it's totally reversed. Now you have an excess of cash. With the excess of cash, you can finance new activities and you can also repay the debt and distribute dividends. Another way to see this evolution with the life cycle, first, you build your market share. After you keep your market share, you defend your market share. And at the end, you harvest the cash flows. So it's a different perspective, but with the same idea, with the same strategic purposes. First, we construct, after we keep it, and at the end, we harvest the cash flows. So we are supposed to have the free cash flow positive, highly positive, few years after you start a new business activity. Of course, it depends if you have in one industry with huge investment or not. If you have low investments, everything can be positive the first year. We see during a previous session the problem of the operating cash flow. In the operating cash flow, sometimes because of your activity, because you are using a cost leadership strategy and you are a small company by comparison with the competitors, you have a situation with a huge operating working capital in percentage of the sales revenue. So because of this, the slope is very high. And at the same time, you have a huge variable cost in percentage of the selling price. So unit variable cost in percentage of the selling price. So because of this, you have a small slope. So the blue line and the black lines are in function of two ratios, the operating working capital in function of the sales revenue, and the unit variable cost in function of the selling price. Sometimes when you increase too much your sales revenue, you transform a positive operating cash flow into negative operating cash flow. So generally, as an investor, you don't want to invest in this kind of company because the operating cash flow is negative with the highest growth rate. So in fact, what you need to finance is the increase in operating working capital. It's not just to finance the net capex, what is normal to finance, but you have to finance also the liquidity problems in the short term, the increase in operating working capital, because you have huge credit terms, because you have huge inventories, and so on. So we saw it already with the business model. So I can come back to Excel file with the business models. It was this one. So you have the correction on Canvas. So it's, for instance, business model number 1. We have a decrease in the operating cash flow because the EBITDA, we have an increase in the EBITDA, which is lower than the increase in the change in operating working capital. The slope of the orange line is higher than this one. So we are decreasing the operating cash flow. In this situation, it's still positive, but I will save another version 2. But here, if we put more variable cost, 70%, so it's not enough. And here, for the operating working capital, 50% of the annual sales revenue here. We will finish with something negative, not already. I put a little more of fixed cost, 5,000 cash fixed cost. So now it's negative, the operating cash flow, and more negative when we increase the growth rate. If we have 20% is more than minus 1,000 in the negative free cash flow. Here, if we have 40% of growth rate for the sales revenue, we have less than minus 2,000, but not very far from minus 2,000. So because the evolution of the operating working capital is higher than the EBITDA we create. So here is the situation without the impact of the income tax. If we want, we can introduce the impact of the income tax. So I can put new lines here and to say we have the income tax rate. So we can suppose, for instance, it's 20% income tax rate. 20%. So now what we need is not directly the EBITDA. What we need is to calculate the EBIT, operating profit. So after the EBITDA, what we can do is we can deduct from the EBIT minus EBIT multiply by the income tax rate. Okay, and we need to know what is the D&A. So I need information about the D&A. We increase this one, so the D&A can be a percentage also in this case. So the D&A expense, we suppose we increase this one every year, and we have the equivalent of 2%. It is not a fixed cost in this case, or we put a fixed, not fixed, 2% in percentage of sales revenue. So in this case, we will increase the variable part. So here it means we have to calculate the EBIT. So the EBIT is the EBITDA minus the D&A expense multiplied by the sales revenue. And now we calculate the impact on the income tax. So it's negative. And because of this, we have this income tax to pay. So here is minus income tax on EBIT. Okay. It's EBIT multiplied by income tax rate. Minus 8. So now for the operating cash flow is now after tax. Income tax. And now we take the C16 minus C17 minus C18 plus C17 minus C18 because it's already minus. Okay, we don't have a huge difference. But now we have the free cash flow after income tax. It's equivalent to what we did from the NOPAT, okay? So we do the NOPAT and we eliminate the D&A expense. Here, we take directly the impact on the income tax for the EBIT. So it's what we say is EBITDA, what we have after this one. And this one minus this one, it's EBITDA after tax. So sometimes we say EBITDA and EBITDA after tax. It means we eliminate, we do minus income tax expense on the EBIT. And it's equivalent to the NOPAT plus the non-cash expense. Okay. So here is no more EBITDA, but I don't think I can change. I will see if I can change the name. So it's, yes, we continue with the EBITDA and operating cash flow after tax. Cash flow after tax. Okay, so it's what we use for the NPV, this one. Okay. I save this one and will give you later with the impact of the income tax. So we can have situation, very bad situation, because of the growth rate in the sales revenue, we transform positive operating cash flow into negative operating cash flow. Because the operating working capital divided by the sales is very high, because the variable cost in percentage of selling price is very high. So thanks to the increase in the sales volume, what we need to do is to reduce this one. We need a reduction in this one. So we are supposed to increase the market share. If you increase your market share, you can decrease the ratio. So it's important to modify the ratio of the red line, maybe to have now this one. So with the growth rate, what we expect is to modify the ratio operating working capital divided by sales. And if you have a very huge growth rate, maybe it's interesting to replace the variable cost by a fixed cost. Because for the fixed cost, you can have economies of scales. Here for this one, you can have learning effect. So it depends if with the increase in the sales volume, you have the capacity to reduce the variable cost in percentage. So to increase the blue line, or if you don't have the capacity to reduce the variable cost with the increase in the volume in percentage of the selling price, in the other case, it's interesting to replace by a fixed cost. So it's what we do generally in the industry with the automatization. We replace the employees by machines and so on. Or for the salesmen, we replace some incentive by lower incentive because now you are selling more products. So you receive 500 or 100,000 donks per product you sell. But now we are selling in an easier way the products because of all the efforts we do for the marketing with the marketing expense. So now you will receive less by product. So you are reducing the variable cost in percentage of the selling price because you give less to the salesman by product. And it's normal if you increase the volume. With a huge increase in the volume, you don't need to give the same incentive by product sold. So what is important is to modify the blue line and the red line, the slope of each one. The blue line is in function of the variable cost in percentage of the sales. The red line is in function of the operating working capital in percentage of the sales. So we can try to replace some variable cost by some fixed cost if we don't have learning effect. So because on this one we have learning effect, on this one we have economies of scale. It depends on which kind of industry, in which kind of industry you are. In some industry you have more learning effect or productivity effect than economies of scale effect. In other industry, we have more economies of scales and less learning effect. So in function of the industry, you prefer to have a huge variable cost or a huge fixed cost. And you will see the effect of the volume. Do we have a decrease in the unit variable cost, learning effect, or do we have a decrease in the unit fixed cost thanks to the economy of scale? So the economy of scale is the capacity to reduce the unit fixed cost. So the unit fixed cost is the fixed cost divided by the volume of activity. So the idea of the economy of scale, it's you need to increase less the fixed cost than you increase the volume of activity. If you increase only by 5% the fixed cost and at the same time you increase the volume of activity by 10%, you are decreasing the unit fixed cost. So you have economy of scales only if you need to increase less the fixed cost than the volume of activity. And it's the same for the unit variable cost. The learning effect is when you have to increase less the variable cost than you increase the volume of activity. Generally, for the unit variable cost, we suppose we have this kind of curve. If you don't invest at the beginning, you have the learning effect, you reduce the unit variable cost. But if you don't invest in the future, you will increase the unit variable cost because now it will be more difficult to produce. You have to spend more hours. It's more difficult for the coordination of the groups in order to work and so on. So we increase the unit variable cost. So the idea is to find this point, the moment you reduce to the minimum the unit variable cost. After this point, you need new investments. You need to increase the fixed cost in order to start a new curve. So this curve is without investments, without increasing fixed cost. When you have this point, now you invest again in order to create a new situation and to reduce again from here your unit variable cost. So with the volume effect, you expect some effect on the variable cost in percentage of the selling price. And you expect, thanks to the increase in the market share, to decrease the operating working capital in percentage of the sales revenue. If you decrease the percentage, you modify from the line 1 to the line 2. So you modify the slope from this one to this one. So the best situation, of course, it's a blue line with a slope higher than the black line for the increase in operating working capital. So now a different situation. Now we suppose, because we can have all the funds we need, we will transform the equation we have from the CVP analysis, cost volume analysis. This one is for the P&L. We will use this kind of equation, but now for the cash flows. You have a target in terms of the change in cash. Why? Is because maybe here is for the operating cash flow. So you have a target for the operating cash flow because behind this, you know you need to finance the net capex. You know you have to pay the debt. You know you want to distribute some dividends. You know you want to repurchase some shares. So you can have a target for the operating cash flow, or you can have directly a target for the free cash flow, for instance, or all the cash flow of the period. So three possibilities: directly all the cash flow of the period, only the free cash flow, or only the operating cash flow. So we have a target for this one. And we will try to find which revenue we need in order to reach the target. So the idea of the CVP analysis is to reverse the P&L. In the P&L, you start from the revenue, minus variable cost, minus fixed cost, you finish with the profit. So from the profit, we want to come back to the revenue. We have a target for the profit. What is needed for the revenue in order to reach the target? So we need this kind of equation. Profit equals the revenue multiplied by the percentage we keep after the variable cost minus the fixed cost. From this equation, we put everything on the other side and we keep only the profit on the right side. So we can say the revenue is equal to the target profit plus the expected fixed cost plus the expected contribution margin rate. If for the next year you expect to keep 40% after the variable cost, if you expect to have 2 billion Vietnamese dongs in the fixed cost and you want a target profit of 1 billion Vietnamese dong, now you can determine what is needed in terms of revenue. And you can check with the commercial department if we can reach this revenue. If it's not possible, if the commercial department say it's not possible to sell all these products at this selling price and to have this revenue, maybe you will change the fixed cost in order to put some new commercial expenses or marketing expenses. Maybe you will change the variable cost because of the commercial expenses. You define a new revenue and you ask, now with the effort we do in terms of advertising, can we reach the revenue in order to have this profit? So in the forecasting process, it's very important to determine which revenue we need in order to achieve this target at the end in the P&L. We can do the same for the cash flows. For the cash flows, we have one equation. The change in cash is because of cash inflows minus cash outflows. In the cash inflows, we can separate two kinds of cash inflows. Cash inflows related to the revenue, cash inflows not related to the revenue. It's the same for the cash outflows. Cash outflows related to the revenue, cash outflows not related to the revenue. So we finish with this equation. We have cash flow expressed in function of the revenue, and we have cash flows independent of the revenue of the year. Why is independent of the revenue of the year? is because, for instance, is from the opening current operating liabilities. Because of the past transaction, you know you will have to pay for the current operating liabilities. It's the same for the fixed cash inflows. We have the opening current operating assets. Because of the accounts receivable, you expect to collect this cash in the future. We have also here what we spend, but is not related to the level of the revenue. We have some cash fixed costs. And for the inflows, we can have other kind of revenues than the sales revenue. So here we can consider other kind of revenues. And we want the cash impact. For what is dependent on the revenue, we need to find the rate. So the percentage for what is for the receipts and for the disbursements. So for instance, if the components expense represent 40% of the revenue, so it means the component cost per product represent 40% of the selling price. You need to know also when do you pay the suppliers of components. And you pay the suppliers of components with 1 month credit term. 1 month credit term. So you need the two information, the percentage in the selling price and the credit terms. With the two information, now you can determine the rate. The rate is 40% because it's in function of the revenue. So 40% we use. But also we want what is cash. Is here the outflow, sorry. It's for this one, okay, for the cash outflow. Because it's components. So it's 40%, but multiply by 11 divided by 12. Because you don't have to pay for the last month because we have 1 month credit term. This is the rate. The rate is in function of the percentage in the selling price of this cost and in function of the credit terms. So I have one exercise on Excel about this. So after you can continue the equation. So at the end, the equation is revenue equal target change in cash plus the fixed cash outflow minus the fixed cash inflow divided by the variable cash inflow rate minus the variable cash outflow rate. So we will do this exercise on the Excel format. We suppose the customer pay with a 1 month credit term. We suppose the suppliers of components are paid with a 1 month and a half credit term. We suppose the components represent 50% of the selling price. The other variable costs represent 20% of selling price and are paid when incurred. The fixed cost for the period is 1.5 million, including D&A expense of 300,000. And the cash fixed costs are paid when incurred. The opening account receivable represents 700,000 and should be collected during the period. The opening accounts payable, current tax, social liabilities, and other operating liabilities represent 1.1 million and should be cash paid during the period. The company expects to have an operating cash flow equal to 1 million during the period. What is the revenue needed for this target operating cash flow? So we can use this equation or we can use the goal-seek function. So I go to the documents. So we are doing revenue for a target cash. So I download the Excel file. So first financial model, we put a revenue and we put the operating cash inflow, operating cash outflow in function of the revenue or not. And we put the calculation of the operating cash flow, which is operating cash inflow minus operating cash outflow. And here we have a goal seek. We have a target of 1.5 million, and we can use the goal seek of the solver in order to find the good input. So thanks to the goal seek of the solver, we can find the input in function of the output. The second financial model, and in this one, now we can use the data table. We reverse the model. Now the target operating cash flow is the input, and the needed sales revenue is the output. So I let you 15 minutes to try to complete the first model and the second model. In the second model, now you can use data table. What if the target operating cash flow is 1.5, 2, 3, or 5, 4 million? What is the needed sales revenue for each one? Okay, so try to complete all this. Of course, you have the same result here and here. Okay, with the first or second financial model, you should finish with the same sales revenue. So try to do it, and I do the correction. So you have all the data, all the input is here. So don't forget, you create only links. Okay, the inputs are here. So you have already all the data. What you need is only here is 60%. Why is I change to 60%? Sorry, we can keep 60%. Or we use the same example. I say what? 50%, 50, 20. We can put 50. We keep the same 50, 20. And the customer are paid after 1 month, and suppliers 1.5, 1.5, 1 month. Okay. I said the fixed cost is 1.5, so we will put 1.5. Say 300, we put 300 for the DNA. And here we have 0 for the moment. It's paid when incurred, so we put 0 in this one. Opening accounts receivable, we said it's 700,000, so we put 700,000. And 1.1 for the opening liabilities, 1.1. Okay, and we want an operating cash flow of 1 million. So we put now 1 million. So this is the version on the slide. Okay, so you can put the same data and to try to calculate. Okay. We do the correction? Do we do the correction? Yes, no? So we'll say yes. Or you want more time to spend a few minutes to finish the two financial model and to use data table? So I propose to do the correction. So we can put what we want here for the moment. So for instance, 2 million or 10 millions, 10 millions. Okay. So now we will create the links for the calculation of the operating cash flow and the operating cash outflow. So one part is linked to the revenue. It's what we will collect. So what we will collect is the revenue of the year multiplied by 12 minus 1 divided by 12. So we don't collect the last month because we have 1 month credit term. Okay. So I create the links to the inputs, and the relevant input here is the 1 month credit term. Just answer to the question because I have a final exam at the same time. Yes. Okay. So this is for the variable cost, the cash variable inflow. Now what is fixed? What is fixed is the 700,000. I should receive the 700,000, okay? Because it's due by the customers, and I suppose it will be collected. So here I can reduce if I have some bad debt expense, and I want the part I will collect. So I suppose I will collect the 700,000. So this is the operating cash inflow. One part in function of the revenue, and the rest is fixed because of the past transaction. In the outflow, I put in minus. In the outflow, I have to pay the suppliers of components. The suppliers of components is in function of the revenue. I spend 50% of the selling price in the components. So I have the equivalent of 50% of the sales revenue in the components expense. But I pay after 1.5 months. So I use the 12 minus 1.5 divided by 12 in order to put the part I will pay during the year. After this I need to do the same for the other variable cost. They represent 20% of the selling price, so 20% of the sales revenue multiplied by 12 minus the credit terms in months divided by 12. I have to pay the cash fixed cost. The cash fixed cost, it's the fixed cost excluding the D&A, because I don't pay the D&A. And the rest is supposed to be cash paid. Cash fixed costs are paid when incurred. So I don't need the credit terms here. And the rest of the cash fixed outflow, it's the opening accounts payable, current tax, social benefit liabilities, and other operating liabilities I will have to pay during the period. So now I have all the links to the inputs I need. And now I have the target operating cash flow. I add the two, the plus inflow minus outflow. So this is the operating cash flow if the sales revenue is 10 million. Now I can use the goal-seek or the solver. If I have the goal-seek, if I use the goal-seek, I fix for the target operating cash flow 1 million. My target is 1 million. And I have to change one input, the annual sales revenue. So I say to Excel, please find the sales revenue for target operating cash flow equal to 1 million. And now we have the calculation. So I need 9,313,433 in order to finish with 1 million. So with the goal-seek, you have all the time to ask for this target, what is the revenue? If we reverse the model, now we can automatically have the results for the sales revenue in function of the input. So now this is the input, and this is the output, okay? So we have directly now the different values for the output in function of the output if we reverse the model. Okay. So I start from the operating cash flow. I want 1 million in this one. So I need to consider as an input because I will change the value after. I will say put 1.5, 2, 3, and 4. So it's not possible to create a link. It's not possible to say is equal to D13. If you do that, you have to change D13, okay? Or you change the input in D13. If you want, you can do that. But what you will change is here, okay? The value you have here. So now this 1 million is an input. So here I can precise input in the second model, financial model. I put different color. So now I have the fixed cash outflow. The fixed cash outflow. So now I need the values in this equation. So I need this equation because I need the output in function of the different inputs. Okay. Sorry, just need to. So I need 1, 2, 3, 4, 5 values. And the revenue is in function of the 5 values. So I go here, I need 1, 2, 3, 4. Why I don't have 5? And the 5 is here, 5, okay? 5 values. So the fixed cash outflow, it's the 1.1 million I have to pay, plus the 1.5 minus the 300,000. This is the fixed cash outflow. So I can put minus 4. Okay. The fixed cash inflow, it's what I should collect from what is due by the customers from the previous period. The variable cash inflow rate is the percentage I will collect during the period. So I will collect 100% of the revenue multiplied by the effect of the credit terms. So I will collect the 12 minus the 1 divided by 12. So I will collect 91.7% of the revenue during the period. The variable cash outflow, so I can put minus, it's the 50%. I take into account the effect of the credit terms, 12 minus 1.5 divided by 12, plus also the 20% multiplied by 12 minus the 0 divided by 12. So now the needed cash sales revenue, we said, it's the target change in cash plus the fixed cash outflow minus the fixed cash inflow divided by the difference between the variable cash inflow rate and the variable cash outflow rate. So we have this one plus what we said, cash outflow is in positive. So I should put in positive. So minus this one in order to have in positive. Minus this one in order to have a negative. Divided by variable cash inflow minus variable cash outflow. So divided by the sum, this one, this one. Okay, so I create the same equation than the equation in the PowerPoint. And now I find the same value, okay, than the here. Thanks to this model, I can change the target of the operating cash flow, and I will have automatically the sales revenue. If I want 1.5 million, I need 11,104,470 with these conditions. If I change the condition I pay after 2 months, now I have the effect of the 2 months, and I can change everything. If I change the target, it's not here I change the target, sorry. I change the target in this one. If I put 1.5 million, now I have the effect. Okay. I need 11,104,470. If I want to find the same with the first model, with 1.5 million, now I need to use the goal-seek or the solver. In the solver, I say to this one, I want a value of 1.5 million by changing which one variable. by changing this one. Okay. And again, you have the same value. Okay. Small difference. I don't understand why, but small difference, but normally you have the same value. Okay. It's because it's 1,500,000. One. It's because of the one. Okay, so with the second model, it's easier to have the solution for different calculations. So now I can use the data table with the second financial model. I don't need to use all the time the goal seek or the solver. So I just need to precise where is the cell with the input is here. Where is the cell with the output is here. I take all the values and the empty cells I want to complete. I go to the what if analysis and data table. I have only inputs in the column here. It's not a matrix, it's just a table. In the column, I have the operating cash flow, the target operating cash flow, and the value is available in this one. Now I can start. I want in euro. Okay, I don't want this line. So now I have the different situation. Okay, and again, I find the same value for 1.5 million. And for 1 million, it was different. And here, I will put again for the 1 million with the goal seek 1 million. So we want 1 million. By changing this value. Okay. Do you have questions about the two financial models we used here? Or it's okay for everybody, the calculation, and I give you the answers after on Canvas. And maybe I can show you with the matrix if I change two inputs, because I think I didn't do it with two. Or I did it. I did it with the matrix. I changed two inputs and I want the impact on one input. I don't remember if I did it already. Yes, no? Did I change two values at the same time and I show you the data table with a change in two inputs? Yes, no? In model 2, why fixed cost is in number? In the model 2, fixed cost is in number. Fixed cost, fixed cash outflow here. This one, you are talking about the 2.3 million. It's the fixed part. It's because in the second model, we want the values we have in the PowerPoint. We need this one. So we say it is 1 million. What is paid during the period, but not in function of the revenue is here. So we have the opening operating liabilities we have to pay. And we have also the cash fixed cost during the period in function of the credit terms. Multiply by 12 minus credit terms in months divided by 12. But here we have no credit terms. In the exercise, it was 0. So if we have 0, we can eliminate all this. Here is the same. We have the opening account receivable, what we should collect during the period. And here we suppose we don't have cash fixed revenue other than sales in here. Because here in reality, what we want is the sales revenue, okay? We can have other kind of revenue also. And all again multiply by 12 minus the credit terms in months divided by 12, okay? And this part is what is in percentage of the selling price. So we have the components, 50% of the selling price, multiply by the credit terms, 12 minus 1.5 divided by 12. We have the 20% for the other variable cost, but here is multiplied by 12 minus 0 divided by 12. So here is equal to 1, this part. No, it's not here, it's for this one. And for this one, we should collect 100%, but we have the effect of the credit terms, 12 minus 1 month divided by 12. So we have two things, in percentage of the same price and the effect of the credit terms. So it's okay now with yes, variable cost is in rate because it's independent, is dependent of the revenue. So we separate what is dependent from the revenue from what is independent. Yes, I can put on canvas now. So I put on, so no, I don't need this. I put on canvas, okay. So the name is target cash, okay? Is the answers to this one. So now you have the correction. And you can include also some credit terms for the cash fixed cost. If we want, we can say the cash fixed cost is not paid when incurred, but after 1 month. And in this case, you can separate also the fixed cost. You can have employee cost, you can have other kind of purchases and so on, and you can separate, and you can create your financial model with all the elements. And in function of all the elements, you can determine what is the revenue needed for this cash flow. We can introduce also the income tax, we can introduce the investment and so on. Just to give you some example and to explain the two ways to find what we need for a target. You can say we create the normal financial model. We start from the inputs. We have the financial model with link to the inputs. And we have the outputs. So we put this one in kind of a scorecard with a chart and table and so on. So you put on one specific sheet. Here you create sheets for the different part of your financial model. And here you separate one sheet for the assumptions or inputs. So normally we create Excel in this way. We separate in the sheets inputs, financial model, and the ending results with the charts and so on. Sorry. Okay. And here we don't want to change this one. So here we create we don't have the possibility to change it. When we create all the links, after we say it's not possible to change it. So I don't remember how to do that, but you can say we don't have to protect sheet. So you use protect sheet after protect sheet in order to avoid to make modifications in the financial model. And when it's finished your financial model, here you use protected sheet. And now it's not possible to change by mistake. What you change is here. All the modification will be in the inputs. It's the same for the outputs. You use a protected sheet in order to modify the link by mistake. Okay. So normally you put in a separated sheets, but here I don't have a lot of input, but this one are in one sheet. So I create one with the inputs. So here inputs. Input first. I create the financial model in function of the inputs. I can separate the outputs if I want to create this kind of scorecard. Here I will put the charts and all the elements in order to have the analysis of the result at the end. And when it's finished, I protect the sheet. So I can protect everything. What I have to select, selected, format cells. I don't know exactly, but you can protect this in order to avoid to change it. Protected, protect. I can use for, you have to check, but normally you protect in order to avoid to change it. Okay. And the first, you can name it inputs or assumptions. Okay. After you have the financial model, sometimes you separate in different financial model. One about the employee cost, one about the calculation of the DNA expense and the property plant equipment, and so on. And at the end, you create the P&L, you create the balance sheet, the statement of cash flow, and after this, you create the key performance indicators, scorecard or key performance indicators at the end. Okay. And in this one, you put some charts in order to analyze the trends and so on. So generally, is how you create the P&L, the Excel file for the financial modeling. Okay. It's okay with the explanations? Yes. So we do the break. I forgot the break. So we do the break and we continue after the session, after the break, with the working capital requirement. So we do this Excel file after the session. We'll try to forecast the cash flows effect of a new product. So here is for a new product. And if we have time at the end of the session, I will present the discounted cash flow methods, how we can forecast the share value, the stock price in function of the discounted cash flows. So I will try to do this one and this one in the second part of the session. So see you in 10 minutes, okay? I stop the recording and we continue the recording after the break. We start again. So now we will see how to manage the working capital. requirement for a new product. I put the correction here with the calculation. So just didn't put a number. Where is this one? So of course I will give you the slide after the session with all the correction. So how to manage working capital? When we say we manage working capital, in fact, we manage the operating working capital and the cash effect. So when we say we manage the working capital, we manage two things, the working capital requirement and the net cash. So we manage the working capital requirement. In function of the working capital requirement, we manage the cash. So the working capital requirement is because of the operating working cycle. It's because we buy some materials on credit, we produce, we create inventories. During the production, when the process is not finished, we have the work in progress or work in process inventory. When the product is finished with the manufacturing part, we have the finished good. We wait the customer purchase it. When the customer purchase it, we wait the moment he pay. We receive the cash, and with the cash, we are supposed to finance what we need to pay because of the suppliers of many things and so on. For the retailers, we use a lot the cash conversion cycle, but we can use it also for the manufacturers. For the retailers, they order some merchandise, they receive the merchandise, they negotiate some credit terms with the suppliers, they keep the inventory during the time waiting the customer is purchasing the merchandise. After it's sold, they wait the customer pay. So generally it's cash paid or cash received. So the collection period can be very low. And the difference between the moment they have to pay the suppliers and the moment they collect the cash from the customers, we name it the cash conversion cycle. So it's a question of periods, the time we keep the inventory. If we keep during 15 days the inventories, we wait 5 days to receive the cash and we pay the suppliers after 10 days. The cash conversion cycle is 15 plus 5 minus 10. So it's 10. So we need to finance 10 days because of the difference between the moment we collect the cash and the moment we pay. And the period is not in function of the same thing. For the inventory periods, it's in function of the cost of merchandise sold. For the collection period, it's in function of the sales revenue. For the payment periods, it's in function of the purchases. So we have a lot of ratios in order to manage the working capital requirement. The first, it's in percentage of the sales revenue. We have to manage the turnover, or we can manage periods. So average collection period is what we name also days of sales outstanding. Average period payment periods is what we name days of payables outstandings. Day to sell inventory is what we name also days of inventories outstanding. With the three periods, now we can calculate the cash conversion cycle. If we want to exclude the VAT and to have the real duration, the real period, the real credit terms, we have to divide something without VAT by something without VAT, or with VAT divided by something with VAT. For the account payable is the same, without divided by without, or with divided by with. And for the inventories, we don't have VAT, no VAT inside. So we don't have the problem of VAT. For the collection of the payment, we have the problem of the VAT, because where is the VAT in the balance sheet? It's in 4 parts. The VAT, it's in the cash account, because you pay the VAT, you collect the VAT. The VAT is in the receivables, because what is due by the customers is with VAT. It's in the payables, because what is due to the suppliers is with VAT, and in the tax liability or tax assets. So the VAT, it's in 1, cash account, receivable, payables, and tax liabilities or tax assets. The rest of the balance sheet is without VAT. So it's a way to calculate by eliminating the effect of the VAT. Generally, for the financial analysis, we don't eliminate the effect of the VAT. So in reality, the day of sales outstanding is with the effect of the VAT inside. So when we calculate a period, we want something from the average balance sheet divided by something from the daily P&L. So balance sheet divided by P&L. So for instance, for the days of sales outstanding, we divide the average accounts receivable by the daily sales revenue. For the inventory, we divide the average inventory, and it's just finished good inventory. We divide the average finished good inventory by the daily cost of goods sold. So annual cost of goods sold divided by the number of days during the year. Why we use the cost of goods sold and not the sales revenue? It's because it's a question of volume. We want to eliminate the problem of the unit cost. In my inventory, I have 10 products. Every day, I sell 5 products per day. 5 products per day. So now I have the total volume in my inventory and the products sold per day. I can say in 2 days, all the inventory is sold. So I need to divide quantity by quantity per day in order to have the number of days. So in reality, I want the same unit cost. Unit cost here and unit cost here is here, in order to eliminate the problem of the unit cost. So we want, it's just a question of quantity, and we want to avoid the problem of the value per unit. If you express your inventory divided by the daily sales revenue, you have 2 problems. The relation between the volumes, but also what is the percentage of the unit cost into the selling price. So one very simple exercise, and I will do it directly because we don't have a lot of time, and I want to present many things. So from all this data, we can calculate the days payable outstanding, the days sales outstanding, and the days inventories outstanding. So I need average. I have already average accounts receivable, average account payable. From this one and this one, I can have the average merchandise inventory. So I use the average. So for the day payable outstanding, I need 100,000, the average account payable, divided by the purchases. But the accounts payable are with VAT. The 1.3 million here we precise without VAT. So we need with VAT divided by with VAT. So we multiply by 1.2. The other way to say the same thing is to say we have without VAT, 400,000 divided by 1.2. So now is without VAT divided by without VAT. If you want to eliminate the VAT impact. For the day sales outstanding, we use the accounts receivable, average accounts receivable, divided by the sales revenue. Here is with VAT, so divided by with VAT. For the day to sell merchandise inventory, we want the average inventory divided by the purchases, divided by what you sell, or divided by the purchases. You have the two possibilities. Here, if we do, with this calculation, with the cost of goods sold. So what is sold? The outflow. If we do in function of the outflow, we have here the inflow, the purchase. We have the opening. Sorry, is not, I forgot to change the values. So here, minus the ending, 620,000, plus the opening, 350,000. Okay. So inflow minus ending plus opening, we have the outflow. Okay. And the outflow is the cost of merchandise sold. What is in the P&L. So here we have 172 days. So we should sell it, this inventory is 172 days. If we want the turnovers, we do 365 number of days divided by the day inventory outstanding. So now we have the inventory turnover. Here is the merchandise inventory turnover. It's the same for everything. If we want the receivable turnover, we use the 365 divided by the days of sales outstanding. So two ways to express how do you manage the credit terms and your inventory, with the turnover or with the period. In the situation of Apple, we can see for Apple, we have very low days inventory outstanding. It's just because of the stores, because in the process of Apple, they don't own the inventories. The inventories are in Foxconn in China, and Foxconn directly sell to the retailers. So Apple avoid the inventories. So we have the equivalent of only 9.1 days of sales in inventory, which is very low. If the company, it's a merchandise, it's a manufacturing company, but in reality, Apple company, it's a merchandise company. They don't produce what they sell. They imagine the product, they have the research and development expense, the advertising expense, but they don't produce the product. In the day sales outstanding, they have to wait 32.3 days before being paid, and they pay the suppliers, Foxconn, after more than 3 months. Thanks to this, the cash conversion cycle is negative, so they don't have liquidity problems. The operating cycle is just this one and this one. So here they explain the calculation of everything, and the situation of Apple is very good thanks to the days inventory outstanding and the capacity to negotiate with the suppliers very huge credit terms. Now we will see the situation. We have a new product. When we have a new product, we think about the cash flow and the working capital requirement in function of very operational indicators. So we have to think about the supply chain and what we want to do. Here we suppose for the raw material inventory, we want the equivalent of 10 days of what we need for the production. In the manufacturing period, we need 30 days in order to produce what we want to sell. After it's produced, we keep in general during 10 days the product before selling it. When we sell it, we wait 30 days before receiving the cash from the customers. And for the raw material, is related to the raw material, we pay the suppliers after 60 days. We have a VAT rate of 20% here. The raw material cost represents the equivalent of 30% of the same price. The rest of the manufacturing cost without the raw material cost represent 40% of the same price. All the raw material is used at the beginning of the manufacturing process, and the VAT is paid the day 20 of the next month. So why is important the day 20 of the next month? Is because you purchase or you sell from 0 to 30 in the month. So in average, at the middle of the month, and you will have to give it back the VAT, or you will be reimbursed about the VAT deductible the 20 of the next month. In reality, you distribute the difference between the VAT collected and the VAT deductible. So you have 20 days here plus 15 here. So in total, in general, in average, the period for the VAT is 35 days. So from this information, now we can calculate the working capital requirement or the operating working capital in percentage of sales revenue or in days of sales revenue. So in the forecasting process for this new product, first you forecast the selling price and sales volume. So now you have the sales revenue. And after you can forecast the working capital requirement in function of this. If you expect to sell for 1 billion of Vietnamese dongs, now you can estimate what is the working capital requirement you need to finance because of this revenue. So it's why we want the working capital requirement or the operating working capital in function of the sales revenue, because in the forecasting process, the working capital requirement will come after the commercial part. So I will open the Excel file. I go to this one, working capital requirement and cash forecast. I download this one. Okay. Oh, it's protected. Why? I created this one and it's protected. Okay. Okay. In the other case, I can take from here, working capital requirement. Okay. And cash flow template. Okay. I save with the correction. So I have the data about the operating activity. After, I will have the commercial forecast, what I expect for the sales revenue. I have the cost structure, what I expect, and I have the investing activity and the financing activity. So here I have a new product and I forecast everything in related to this new product or this new business activity. So here we can go very far in this one because we can create the working capital requirement in function of the sales revenue. We can create the P&L forecast for 5 years with the growth rate in the sales volume in the cash fixed cost. We create the free cash flow, so it's a way to revise the NPV. And we find the same thing than with the NPV with the economic profit at the end, MVA, okay? In the between, I also created all the statement of cash flows, and I created all the managerial balance sheet. So we will not have the time to do everything, but after I will give you the correction of all of this. So for the moment, we want to create the forecast of the working capital requirement in function of the operating indicators about the operating activity. So for the raw material inventory, the period, we expect to have the equivalent of 10 days in the raw material inventory. The raw material cost represent the equivalent to 30% of the selling price. So what you can expect as the raw material inventory in days of sales revenue, it's 10, but multiplied by 30%. So now we express in function of the sales revenue, because with this column, we want to add everything from this column. So we want something coherent because everything is already in function of the sales revenue. The problem with the column with the periods, here, we can have the calculation of the cash conversion cycle in this one. With this column, we can have the cash conversion cycle. But in the cash conversion cycle, is not in function of the same values. We estimate something in function of the purchases, but the purchases are in function of the purchase price. We estimate something in function of what we sell, but is in function of the same price. So the problem with the column of the period is not in function of the same value. If you want at the end to add everything in order to estimate your operating working capital in function of the sales revenue, you need everything already in function of sales revenue. So we need the period, but multiply by the percentage of the selling price. This cost represents which percentage of the selling price in order to transform the period into something in function of the sales revenue, in days of sales revenue. For the work in progress inventory, it means it's a product not already finished. We know, so here it's about the production process, 30 days, but it's not finished, the product. So we know that the raw material cost is here from the beginning. So because it's here from the beginning, we put the 30%. The 30% is certain, but for the 40%, it's only if you finish the manufacturing process. Here, we don't know where is the work in progress inventory. We don't have the details. So here we suppose the work in progress inventory, it's at the middle of the manufacturing process. So divided by 2. I will explain this here. At the beginning of the manufacturing process, we already have the raw material, which represent 30% of the selling price. The finished good, it's at the end of the manufacturing process. So here the product is finished. The work in progress or work in process inventory is because of all the inventories during the manufacturing process, excluding the raw material inventory, excluding the finished good inventory. But at the end of the period, many products can be not finished. We don't know where is the work in progress inventory. So in average, we suppose it's at the middle of the process. The cost of the process of manufacturing, it's equivalent to 40% of the selling price. So how can we value the work in progress inventory? We are sure we have the raw material cost because it's all here from the beginning. It's the hypothesis. We said all the material is used at the beginning of the manufacturing process. So we already have the 30% from the beginning. And for the rest, we are at the middle. So it's why we have the 40% divided by 2. So we come back to this one. So the manufacturing process takes 30 days in total. The value is only 30 plus 40% divided by 2. So here now the equivalent in days of sales is 15 days. So the finished good inventory is finished with all the manufacturing process. So inside the cost of the finished good, we have the 30% plus the 40%. So, sorry, it's not here, it's after. Okay. In the finished good inventory, we keep it during 10 days before selling it. So we have 10 days. So we have the 10. Okay. So we multiply again the 10 days, we keep it by the value in function of the selling price. So 7. For the account receivable, the customer paid, suppose they will pay after 30 days. So we have 30. And here what we collect is more than the selling price before VAT. What we collect is the selling price before VAT multiplied by 1 plus the VAT rate. So what we collect from the customers is 120% of the selling price before VAT. So here we multiply by 1.2 by 36 days. And now we deduct the VAT collected. Because of this, we create some tax liability. We are in the liability, so it's in minus. When it's in the liabilities, it's minus. When it's in the assets, it's plus. So the VAT is given to the state, we say the 20 of the next month. So we have the 20 plus 0 plus 30 divided by 2. Okay, so we say the 15 plus 20. So we have to pay to give it back the VAT after 35 days. What we give is the equivalent of 20% of the selling price before VAT. And here is negative because it's in the liabilities. So if we give back the VAT at the moment we collect the VAT, if we have the same period 30 and 30 here, we can take directly without VAT. If we have 30 in this one and 30 in this one, you can say directly it's without VAT, it's 30 days. So the 30 days is directly what you put here. The problem here it's you don't give it back the VAT, at the same time you collect the VAT. Because we have a difference in the period, we separate the two. If we don't have a difference, in this case, you can sum the two in one line. For the accounts payable, we pay the suppliers, we suppose we pay the suppliers after 60 days. For the VAT, what we pay with VAT, and what we pay, we present 30% of the selling price. So 30% of the selling price without VAT multiplied by 1 plus the VAT rate. Very precise here if you want, of selling price without VAT. Without VAT. So again, I multiply and it's minus because it's the liabilities. For the VAT collected is deductible. I suppose it's deductible. So it's in the assets. So again, it's the 35 days. It's about the 20% of the 30%. And now I have the operating working capital in percentage, in number of days of operating working capital. If I want in percentage of the sales revenue, I just need to divide by the number of days during the years. So the working capital requirement represent here 9.5% of the sales revenue. So it means I will consume, when I will create the working capital requirement, the equivalent of 9.5% of the sales revenue. In terms of cash, it's very important to estimate this one. So here it's in 14, I put in 14. 14, okay. And now I want to create the forecast for the P&L. I have the working capital requirement. I can create the P&L. And after this, I can calculate the cash flows. I need the P&L forecast in order to estimate the NOPAT if I want to calculate the free cash flow. And if I want the statement of cash flows with the indirect methods, I need also the net profit. Okay, I need the P&L. So for the sales revenue, suppose we are a producer and we don't sell directly to the end customer. We created a marketing study in order to estimate what the customer wants to pay. If we propose 120 euros to the customer, we should be able to have a volume, sales volume of 16,490. The problem is we don't sell directly to the end customer. We sell to the retailer. So we study what is possible as a selling price for the customer, the end customer. What is the volume we can expect from the end customer? But in the between, we have the retailer. So what we need here, we are the producer alpha. What we need is the selling price for the P&L. And we know the selling price for the end customer. So the end customer is able to pay, sorry, it's here, 120. But this selling price is not for us. First, we have to eliminate the VAT because in the P&L is without VAT. So the selling price with VAT divided by 1 plus VAT rate is equal to the selling price without VAT. So here we have the 20%. So this is the selling price for the retailer, which is included in the retailer P&L. And now what we want is for us as the producer. we know that the retailer wants a gross profit margin of 30%. So it means if we have 30% here for the retailer, it means the purchase price for the retailer is the rest. So don't forget the gross profit margin. Gross profit margin is equal to the sales revenue minus the cost of merchandise sold. Here we are in the retailer, divided by the sales revenue. So we can say the gross profit margin is equal to the selling price minus the purchase cost, divided by the selling price. And here we suppose assumption the unit purchase cost is equal to the unit purchase price. What is the purchase price of the retailer? The purchase price of the retailer is equal to the selling price of the producer. So now we have the selling price of the producer. So we can say then the unit purchase cost for the retailer, cost of the retailer is equal to the selling price of the retailer multiplied by 1 minus gross profit margin. From this, we can deduce what is the selling price of the producer. Okay, and don't forget the selling price is VAT is equal to the selling price without VAT multiplied by 1 plus VAT rate. We have already with VAT, and we want to come back to the same price without VAT. So we do the reverse, we divide by 1 plus the VAT rate. So now we can put the sales revenue in our P&L. It's equal to the selling price of the retailer. We are the retailer, multiplied by the sales volume. In the variable cost, say we estimate it's equal to 60% of the selling price of the sales revenue or selling price if it's a unit variable cost. So the contribution margin is the rest. The contribution margin rate, it's the contribution margin divided by the sales revenue. In the fixed cost, we have the cash fixed cost. $250. We have the non-cash fixed cost because of the depreciation of the investment. So now the total fixed cost is the sum of the cash and non-cash fixed cost. So after we can suppose we continue to depreciate, we don't have new investments, so we continue with the same. And for the cash fixed cost, we can have some increase because of the salaries, because of the new employees, and so on. So increase the cash fixed cost by 10%. Okay. So again, we have the calculation of this one. For the sales revenue, we increase because of the sales volume effect. It's the same for the variable cost. Increase. So we keep the same contribution margin rate. The contribution margin rate is in function of the ratio between selling price minus the unit variable cost divided by the selling price. Here we don't change the selling price, we don't change the unit variable cost, so we keep the same contribution margin rate. So the operating profit is the contribution margin minus the fixed cost. Interest expense is because of the financing activity. We have a new debt multiplied by the interest rate. Now we have the profit before tax. So first is negative. We have the income tax. We can suppose we can have some tax assets. If we have a loss with a tax asset, it means we can reduce what we will have to pay in the future when we will have some profits. So it depends on the tax laws, tax rules by country. But in France, for instance, when you have a loss, you accumulate some tax assets, and at the moment you have benefits, net profits, you can pay less taxes thanks to the tax assets accumulated. So I will not have time to complete everything. So I stop here with this exercise, and I show you directly all the correction. So I created all the forecasts. So I calculated the NPV of this project for everything. I created the tax assets because at the beginning I start with some losses. Okay, just the first year. It's different values. Maybe I change the assumptions at the beginning. You can change inputs. In function of the inputs, you will have the effect on the financial model. I created the statement of cash flows. So here I used the data for the calculation of the weighted average cost of capital after tax in order to discount the free cash flows. Okay. I created the statement of cash flows with indirect methods, the operating cash flow. I have the investing cash flow and the financing cash flow. I created the managerial balance sheet with financial assets, net operating assets, and capital employed. I have the equivalent in the invested capital. I separated the profit of the year from previous years, like in Vietnam. We have another presentation of the managerial balance sheet, as we said, the net operating assets in one side and the financing of the net operating assets on the other side. With the second managerial balance sheet, I created the calculation of the economic profit per year. You can say we destroy some value the first 2 years, and we create value for the shareholders in the year 3, 4, and 5. Thanks to the economic profits created during the year 3, 4, and 5, we compensate what we destroy during the first 2 years, and we take into account the time value. And you can see the value you have here, 14,593, is equivalent to what you have with the NPV calculation. And that's it. I created nothing more in this Excel file. So it's a kind of revision of what we saw about the NPV, about the statement of cash flows, about and about the working capital requirement. So of course I will give you this one on Canvas. So now what you have to change if you want to create new models is just the beginning, okay? The inputs are here at the beginning. This one, and here I included what is expected by the shareholders in the cost of equity, okay? For the calculation of the weighted average cost of capital, I included what is expected by the shareholders. So it's here, the 14% is included. For the weighted average cost of capital, what we do is to use only for the first year, at the beginning. we don't modify the weighted average cost of capital per year. We don't have a different weighted average cost of capital per year. We simplify and we use only one at the beginning of the project or in general for the company. Okay, let's finish with this one. And in the last 15 minutes, I would like to present a forecast, the discounted cash flow methods. Discounting cash flow methods with this one. So this one, I created this one from a book I like for the financial modeling. So for the financial modeling, I use a book from the MIT. You can find it also in internet, financial modeling. Benninger. So I use this book, 4th edition, the last one, from MIT Press. So it's you can have this kind of financial model in this book, and you have Excel file on internet. If you are interested by equity methods, you have other financial modeling for equity research, I think is the name. And this one is also very interesting. They propose all the methodology in order to estimate the stock price of the companies. And they give the Excel file to create all the financial model, and they apply on one company. I don't remember the name of the company they give. It's American company, and they use it for, I forgot, but you can have all the Excel file for this one. So maybe I have this one in Audencia. Financial modeling. Financial modeling, where is the financial modeling? Okay, and I put here, no, here is Benninger. Entrepreneurial finance is another one. Maybe in the books. In the books, I have the Excel file. So they created for one company, big company. It's a transport company, I think. So I come back to cash management. So now we will do this one. So we use a pro forma financial model, and I will present the interest of this kind of model. So when we value the share in function of the discounted cash flow methods, we use this kind of model. More complex than this one, but it's this kind of model. Okay, why is protected? I hope you can download the Excel file. For you, it's not a problem. Because here I can download the Excel file. Okay, don't save. So I will use directly from here, pro format, financial model, new version. I don't remember which version I put. I suppose it's this one. It's the same. Tell me if you have problem to download the Excel file. So first, what we have to do is to fix some ratio. We fix the ratios in order to have some estimate about the future. So we suppose we are at the end of the year 2020, and we want to forecast for the P&L and the balance sheet for the year 2021 to 2025. At the end, what we do that in order to forecast the free cash flow. With the free cash flow forecast, we can calculate the enterprise value. So what we will do, we have in one side the net operating assets. Net operating assets. On the other side, we have the equity and financial liabilities. Normally more equities and financial liabilities. We want the market value of this. So we have the market value of the net operating assets thanks to the discounted cash flow methods. So with the discounted free cash flows. So here we use the discounted free cash flow to firm. And here, so we have the net, is not the financial liabilities, the net debt. So it means the financial liabilities minus the cash and marketable securities. And now from this value, we will name 1 and 2, the value of the net debt at the beginning. We can have the market value of equity. The market value of equity is the market value of the net operating assets minus the net debt. Okay. So the market value of this market value is what we name also enterprise value. Enterprise value. The enterprise value is the market value of equity, the market capitalization, plus the net debt. If you add the two, you have the enterprise value. So you can find the enterprise value from the financial market. You take the market capitalization, you check in the balance sheet the net debt, you have the enterprise value. Or you can calculate what should be normally, according to the fundamentals of the company, the enterprise value. In this case, you use the discounted free cash flow to firm. So two ways to have the enterprise value: from the real value from the market or from what could be expected according to the fundamentals of the company. So what we do is to calculate the market value of equity from the discounted cash flow methods. The other way to present also the calculation of the market value of equity is to say we have the capital employed in one side, we have the invested capital on the other side, we have the net operating assets, we have the financial assets, we have the equity, we have the financial liabilities. So from the net operating assets with the discounted free cash flow to firm, we have the market value of the net operating assets. Market value of the net operating assets of the number 1 plus the number 2 minus the number 3. We have now the market value of equity. So we can have direct methods in order to have the market value of equity. The direct methods to have the market value of equity is the discounted dividends, the discounted free cash flow to equity, and here we use indirect methods. So what we use is methods starting with the net operating assets. Okay, so what we want is to have the market value thanks to 1 plus 2 minus 3. And this one means minus the net debt. Okay, so this is what we use here. So we have some fixed ratio. We suppose during the year 2021 to 2025, we will respect this ratio. We have to create some inputs. We suppose they are fixed. So we increase the sales revenue by 10% every year. We have the current operating assets equal to 15% of the sales. Current operating liabilities equal to 8% of the sales. We need to increase the non-current assets in function of the sales. So we have the net capex in percentage of the sales. We have the cash cost of goods sold in percentage the sales. We have the cash SG&A expense in function of the sales. We have the average lifetime of fixed assets. We have the interest rate on average debt, interest received on financial assets, income tax rate, and dividend payout ratio. It's a cash dividend, of course, cash dividend payout ratio. All this ratio, now we can create the P&L forecast and the balance sheet forecast. What is important in Excel, in this case, you can have this kind of relation. You can have B in function of A, C in function of B, and A in function of C. In Excel, they don't like this kind of iterative calculation. They say there is a problem. It's not normal to have A in function of C, but at the same time, C indirectly in function of A. So you have to say to Excel, I accept the iterative calculation. So we need this in our model. So you go to Excel and you say in the options, file options, in the formulas, you say, I accept the iterative calculation. And you say how many iterative calculation you accept. 100 is enough for what we do. Sometimes you need more iterative calculation in order to find the good answer. So here we accept the iterative calculation. So now we can do all the calculation. We suppose it's already respected the ratio in 2020. In reality, we find the ratio from the past data. So it's what we have in 2020, and we apply to the future. So the cost of goods sold represent 55% of the sales revenue. We put dollars in order to keep this one. The gross profit is the difference. SG&A expense represent 20% of the sales revenue. The EBITDA here is the difference. So it's why is the cash is cash cost of goods sold, okay? Cash. So we finish with EBITDA. Now the depreciation amortization expense, it's equal to the gross value divided by the average lifetime. So if we keep it in averaging 8 years and we use the straight line methods, we can directly divide by 8. 100. So it's in minus, it's expense. So the EBIT, it's this one. Interest expense is interest rate multiplied by the debt, this one. Interest income is interest rate on the financial assets multiplied by this one. So the profit before tax is the sum of the three. Income tax expense is the profit before tax multiplied by the income tax rate. So the net profit is the sum of the two, but already negative income tax expense. For the EBIT, for the dividends, we distribute 40%. So the retention rate is 60%, what we keep. For the next year, it will be in function of the average debt, average marketable securities. So here we calculate in function of the average. So minus the interest rate with dollars multiplied by the average debt. Average debt is here. Okay. Opening plus ending. The interest income is in function of the average cash marketable securities. I put dollars here. Okay, dollars here also. For the rest here, it's in function, we can say it's in function of the average. So here, the depreciation expense is the average fixed asset at gross value divided by the average duration, lifetime. Okay. For the sales, it's multiplied by the growth rate. You can put dollars here. So now we can use the same calculations in here. We can use the same calculations in here, and here the same calculation. I forgot the percentage, the dollars here. Okay, here is the difference. Okay, so now I can use all this for the rest. Here, I will use the balance sheet in order to find the cash. The current operating asset is equal to 15% of the sales revenue. Here I put dollars. The net value is the gross value minus the accumulated depreciation. Accumulated depreciation is the previous accumulated depreciation plus the new depreciation. We say the net capex is equal to 10% of the sales. So it means we increase the gross value because of the 10% of the sales. So I put dollars. Okay. I keep the same as in this one. I will find the cash by difference. So I use the total liabilities and equity minus the non-cash assets, minus this one, minus this one. This one is equal to the sum of this one minus this one. So now the total assets is the sum of this one and this one plus the net value. You can use the same formula all the time. The current operating liabilities, it's a percentage of the sales. And I keep this one. Okay. The debt is the difference between the rest in this case. So it's total assets minus other liabilities minus the equity. So now we have the balance sheet balanced at the beginning. It's not possible to use at the same time the balance sheet in order to forecast the cash, the debt, and the capital stock. So we suppose the debt will not change. We suppose the capital stock stays the same. For the retained earnings is the previous retained earnings plus the change in retained earnings. Here I forgot the dollars. Okay. The total liabilities and equity is the sum of the three. And this is this formula. Normally, I hope everything is working. I can use for the rest. So now it's finished with the balance sheet forecast and the P&L forecast. So I use in reality the balance sheet in order to have the change in cash. So I increase by 90, I increase by 102, and so on. So it's a kind of statement of cash flows with indirect methods. But what I want is only the free cash flow. For the free cash flow, I start with the profit after tax. I start with this one, but my problem is I have too much things. What I want in reality is a NOPAT. So I need to eliminate the interest expense and interest income after tax. So I do the reverse. I eliminate this one, and I eliminate the interest income. So the NOPAT, it's the net profit plus the interest expense after income tax minus interest income after tax. It's another way to calculate the NOPAT, is to start from the net profit and to eliminate the financial profit. Now I need the depreciation expense in order to eliminate the non-cash expense. So plus the depreciation expense. I need the change in current operating assets. If I increase the current operating assets, it's a cash outflow. So I use opening minus ending. It's minus, I consume the cash when I increase. And for the current operating liabilities, it's the reverse. When I increase the current operating liabilities, I save the cash. So now I have the operating cash flow. The change in net capex is opening minus ending value. So if I increase, it's because of the net capex. The free cash flow now is the sum of the two. Now I can use all this information for the other years. Now I have the free cash flow per year, but only for 5 years. I suppose I can have a good forecast only for 5 years. I need, in order to have the market value of net operating assets, to have the terminal value. For the terminal value, I suppose I will increase the last free cash flow I calculated by some growth rate. In the future, I will increase by 5%. And I will increase for eternity. So I discount for eternity by 10% the weighted average cost of capital minus the growth rate. Now I have all the free cash flows per year, including the terminal value. With all of this, I have the enterprise value. So I can eliminate this. Enterprise value is equal to the market value of net operating assets. Thanks to the net operating assets, I created all the free cash flow. So I will discount all this, NPV equal NPV. At the discount rate, no, I don't have this discount rate, it's here. Discount rate 10% of all these values. I include the cash at the beginning, plus the financial assets. Minus the debt, so I will have minus the net debt at the beginning. Now I have the market value of equity. I divide by the number of shares. I suppose here we have 1,000 shares. This is the market value, the share value, according to the discounted cash flow methods. I say with answers. So I will put, if you are interested by this kind of model, you can tell me also, it's possible to have some homework about this. In this case, you have to decide which company you want to analyze and to create the ratios and to estimate the free cash flow of this company in the future and to explain why you decided to use these ratios to calculate the value per share and to explain your model. So it's possible also to create a model like this for one company if you want to use this kind of model. It's another kind of homework I accept. So I accept 3 homeworks. One is the reconciliation of the balance sheet, change in balance sheet and statement of cash flow. Another one, it's the NPV and the market value added. And the last one is to create a discounted cash flow methods in order to estimate the share value of one company. So I hope you appreciated this course, these 15 hours we had together. I try to show you many different items around the cash management. It was more a long-term perspective on the cash, more perspective from all the full company. And if you want more treasury aspects, I have a book and I can scan some part of the book if you want something about this. But I hope you found the course interesting and the use of Excel interesting also. So in your may we have your email contact, please? Yes, of course. So if you have questions for the case study, the homework, if you have questions for the course, don't hesitate. So I wait the list of the group with your choice. Do you want a case study about one specific company and you want to explain why this change in balance sheet is with a cash effect or not a cash effect? Do you prefer a homework about NPV and market value added? Do you prefer a homework about the valuation of the equity, the market value of equity from the discounted cash flow methods? You tell me which case study you prefer. If it's not the NPV and market value added, which company you want to study? And after this, yes, by a group of 3 people, you can keep. And after you decided which one you say you want, I will give you your homework, okay? So I wait the list to Monday with your choice. In function of the choice, I will give you one specific homework for each group. You decide the company and I say what you have to do with your company. You decide to have the discounted, the NPV and the market value added, and I give you one template you have to resolve, okay? But I want a different homework per group, so I will give you your homework in function of your group, okay? So I don't want you want to study the same company in the different groups. If you want to reconcile the change in balance sheet with the statement of cash flow, you have to decide which company you want to study, and you have to decide about American companies, because in this way we can have the Excel file. Yes. So first you say you have 3 choices. You can decide to take the NPV and market value added project. In this case, it's a lot of use of Excel function in this one. You can decide to take to explain why the change in balance sheet, what is with the cash effect, and what is without and with a non-cash effect. So it's interesting generally to understand we have the change. This is the cash effect, this is non-cash effects, and to explain the two. So here is for American company, for US company, because we can find easily the Excel file on the financial market, of course. So US company on the French, US companies on the financial market. So for each line item of the balance sheet, you try to separate the two and to explain what we have in the non-cash effect. Or the third project is the discounted cash flow methods, or the valuation for the market value of equity. So what we did now, and you have to decide on which company you want to use it. So you can use it for a Vietnamese company, American company, European company. So you apply to the company of your choice. Okay? So you have to decide between the 3 projects, what you prefer. You tell me what you prefer, and I give you the wording of what you have to do. Okay? So yes, first you create the group, you give me the homework you prefer, and after I give you the wording. So if you can tell me what you want by Monday, it will be perfect, or Tuesday. And after that, I will let you 1 month to do the homework. Okay? It's okay for everybody? Okay. I hope you appreciated the course. I put the correction of what we did, the PowerPoint and the Excel file, and I wait your email with the groups and to the email I gave you. So where is the email? Maton gmail.com. Okay. I prefer to use this one than the professional one because in the professional, I can put many things in the email box. In this way, I can have more emails. Okay, perfect. Have a good weekend, everybody. And I put the correction. And if you have questions, don't hesitate to send me an email. Okay. Bye. I stop the recording. Thank you. Thank you for your comment. Very nice. Bye. I hope now you want to create financial models for everything.